What's up, guys? Welcome back. Today we have to talk about how to close down an option, how to exit an option, how to get out of an option, whether it's made a mistake, whether you've taken a ton of profits and now you want to close it and get rid of it, whether you've taken a ton of loss and you kind of want to mitigate losses. It's incredible to me inside the comment section, and it's fearful how many people are placing options trades without knowing how to get out of them. So we have to talk about it. I'll talk about basic selling calls and puts, cash secure puts and covered calls, how to get out of buys, how to get out of spreads. I'll talk about everything so that if you're in a little bit of trouble, you can get yourself out, or if you feel like you've made enough profit and you want to get out, that's fine too. I'll jump into Robinhood, show you how to do it on that particular platform as well as some others, and also show you what the premium value chart means and what it looks like, because so many times people see that chart and think that they're in a ton of loss or in a bunch of hot water, when in all actuality, they don't really even know what that graph means. So I'm going to show you that as well. And by the end of this video, everyone will be able to take a deep breath and then we'll be able to move on and everything will be a-okay. Please, guys, understand that most options trades do not go in the way that we want it to go. Understand all the possible outcomes before entering the trade. I mean, I remember when I was playing lacrosse as a kid, before the coach blew the whistle, he would scream to everybody on the field, "All right, what are you going to do if you get the ball?" And you'd think, okay, I'm going to run this way, I'm going to pass this way, I'm going to shoot, I'm going to all these things. And if you play sports, you know the person on the team that did not want the ball. The reason they didn't want the ball is because they didn't know what to do once they had it. And I feel like right now, there's a bunch of people trading options, whether it's because of the GameStop, AMC debacle. There's a lot of people running around that do not want the ball right now, and they're looking for that edge strategy. So guys, please understand all possible outcomes before you make a trade. It's as simple as that. You know, ask questions. Inside my Discord, there are a ton of people asking questions before, but there's also a ton of people reaching out saying, hey, I'm in this position now. How do I get out? This, that, and the other thing. So please understand all the possible outcomes, and I'll talk about some of them, not for every single trade, but I'll talk about some of them. Understand your outcomes before making the trade so that if something were to go right or wrong, you can get out and either take some profits or mitigate some losses. That's the main focus of this video. So you guys know I love the digital whiteboard. I'm going to give you some visuals as well, write some things out so that we could see everything here in real time. So first off the bat, guys, this is pretty basic, but we need to understand that every option or option strategy is pretty much going to be based upon two things, either selling calls and puts or buying calls or puts. Now, for some vocabulary, and just so we can all stay on the same page, when we say we are selling an option, that means we are writing an option. We are creating it. We are putting that option into the ether that is options trading. And oftentimes when we do so, we are going to receive a credit. We are going to receive money in premium from the buyer. All right. And this is shown inside options as a -1 C or P. The opposite to that is buying calls and puts. All right, so when we buy a put, this is often going to be a debit, because when we buy things, we have to give money away. In this case, we call it premium, and this is going to be shown as a +1 call or put. We have a -1, we gave something away. When we buy something, we get a +1. And this plus and -1 is going to be very, very important when we try and close an option. Now, in each one of these options or option strategies, there's really only 3 scenarios that can take place. We have to know our outcomes, okay? 3 outcomes that can take place. Number 1, the option expires worthless at expiration, meaning the value of that option is now 0, or really $1, we'll see it. But this means that regardless of what the value of that option was over time, at expiration, it is now worthless, all right? This is going to be out of the money. And if we are selling options, this is when we accrue max profits. We get to keep that premium, we keep our collateral, and we repeat. Now, oftentimes, guys, like I said, the value chart may look like this, and I'm going to show you that. But what we're saying is at expiration, it dives to 0 and the option expires worthless. This is great for sellers. This is bad for buyers. And really, I keep wanting to use this value of the option, because when I show you that chart, right, that's what the brokerage is showing you. And that's when people get all freaked out by the current value and they don't think in terms of expiration and what that value really means in real time. The other scenario is this option expires in the money, okay? And at this time, you will either be assigned if you are selling options, or you will exercise the option if you are buying options. Side note, I just made a video like last week. I'll link it down in the comments. Guys, if you are buying options, you do not want this to go to expiration. You do not want this to be exercised. All the reasons why you don't want to exercise options are inside that video. There are a few rare cases, but at assignment, you are either going to have those shares called away from you. You are going to be required to purchase 100 shares if you are selling calls and puts. And if you are exercising, you are buying calls and puts, now you're going to be required to do the same. You're going to have to buy 100 shares at that strike price that you chose. Now, as far as who's this good for, guys, if you're selling covered calls, like I love assignment. You should never be fearing assignment if you're selling calls and puts, because you are going to pick a strike that's either above your basis for a covered call, and you're like, oh, all right, I lose that share. I'm not married to him, but I'm going to get that. Or if you're selling a put, you're going to buy those shares at the price that you determine in the strike. When you are writing this option, you get to create the terms. So you should never fear assignment. It might suck sometimes, but you should never be like, oh man, I'm going to get assigned on my option. That means that you were either greedy or did not know your possible outcomes. And the last, and really what I'm going to focus on for the remainder of this video, is how to exit or close a position. You're going to want to do this for one of three reasons. Number one, you're going to want to lock in profits. Right now, maybe the value of that option is in your favor and you want to lock in profits and you want to wash that away, exit and close that option. The other one is to cut losses. And this is the one I'm seeing a lot right now. Maybe you're in a trade and you don't think it can go well and it's just diving in value and you want to get out. You want to exit it before, stop the bleeding, if you will. This would be another reason you want to exit or close your option. So we don't always do it for bad reasons. I've made videos about how I close for profit. I'll leave that video down as well. But like this is not all bad. Sometimes we close for good reason. And number three, like I said, sometimes we want to roll our options further out in expiration or up in strike. So you can roll to do either one or two. You can roll options to cut losses and you can roll options as well to lock in profits. So now how the heck do we do this for calls, puts, and spreads? Well, let's first understand what's happening when we start a contract, when we enter an options agreement, okay? So the first option agreement that we can get into is we can sell to open. Now, this is going to be with your covered calls and your cash secure puts. I'm not going to talk about naked calls and puts in this video. That's for another day. I'll mention them quickly when they come up, but really this is going to be covered calls and cash secure puts for a majority of my audience, right? Selling to open. Now, remember, sell is to write. So here you are, and you're like, all right, I'm going to write up this contract, and this contract is going to have the strike that I want. It's going to have the expiration that I want, and I am also going to make the premium that I want to collect. Now, say I say, all right, I want that to be $12. I want the value of this contract to be $12. You scream out into the world, hey, I got this contract with this strike, with this expiration, and I'm looking to get this premium. Does anybody want it? And you wait and you wait, and then there's somebody over here that's going to be the buyer. And he says, I'll take that contract for $12. And you say, sweet. So he sends over $12 to you in premium that you collect right away, and you send to him back the option worth $12 at that current moment. That's what we are doing when we sell to open. When we buy to open, now we are saying, hey, I got this $12. Does anybody have a contract that has a certain strike price, has a certain expiration, and you'll take $12 for it? And then there's somebody over here that wrote that option that says, hey, I got a contract for you. So now you take this contract, it comes over to you, and you as the buyer, you now debit and you pay that person $12 for the contract that's in your hand. So that's what happens when you sell to open and when you buy to open a contract. So that's going to start the options value graph that we are going to see. And over time, that options value is going to vary. So you sold a covered call. So right now, inside your brokerage, it says -1 call. And the value that you got it for was $12. So your chart is going to start right here at $12. Now, over time to expiration, that is going to do something like this. Hopefully, we want it to stay down because we want this call to expire worthless. But now when it's way up here at $20, the value of that option is $20. So it's going to show that you lost $8, -$8, because if you would have sold here, you would have gotten $20 as opposed to $12. At the opposite of that, when it dips down to here at say $10, it's now going to say that you profited $2 and you're in the profit zone because the current value of that option is less than what you sold it for. This is when we might want to buy to close. So now what we did was we started with a $12 option. It is now worth $10. So now there's somebody out there saying, hey, I got this $10 contract. Anybody want it? You're like, I'll buy that. I'll buy it for $10. So what you're going to do is you are going to buy to close. And what's going to happen now, just like here, you are going to get debited $10. Now you're going to receive that contract back, and this is a little counterintuitive. The contract is essentially with yourself. So you can't like profit or loss with yourself. So that contract is closed. And what will happen is you will now lock in $2 of profit that will be yours. And this can happen all the way up until expiration. And when you do it, how much profit you take in is really 100% up to you. It's personal preference. But we're never going to buy to close a covered call or cash secure put when the value of that option is more or greater than what we sold it for. We are going to hope that theta eats away, and then maybe when it's down here at $8, we can buy to close, we give back $8, but now we net and keep $4 profit. And as the seller, you don't want time to be able to screw you over. You get in, you place that option, you lock in whatever profit you want. For me, it's 75% with my covered calls, 40% in my poor man covered calls, and then I get out. Just personal preference, and then I repeat. That's what buying to close means for a simple covered call and cash secure put. But now how do you close it, all right? Now on Robinhood, when you're on the desktop, they make it really easy. And I think this is where this is kind of hurting people because they just have a buy to close and people don't know what's actually happening. And then they get to the app and they have no idea because there's no buy to close on the app. Guys, to close, all you do is the opposite contract at the same expiration. So if you have a -1 call that expires on 3/22, what you're going to do is simply buy a call with the expiration of 3/22. And if the premium you pay is less than the premium you collected, you are going to win in that situation. Now, if you need to cut your losses, you might buy to close, but the premium that you pay is more than the premium that you collected. That is a loss. Now, what does that look like on the buy side? Well, on the buy side, it's still a $12 premium, right? But we want, when we are the buyer of options, we want the value of that option to go up due to extrinsic value, due to implied volatility, due to share price. We want this to go up. So now maybe over some time, maybe now it's trading at $15. Well, now you can say, hey, I got this contract. It's worth $15, and you're trying to sell to close. You're trying to sell this contract that's now worth more than what you paid for it to somebody else. So we are going to see a sell to close. So it might say now we bought an option with an expiration date of 3/22. Now it's at $15 when it was at $12. So we debited $12 when we bought this option, but now we can sell it back for $15 worth of premium. Now we will net $3. And to do so, we will do once again the opposite. We will do -1 expiration of 3/22 for this underlying stock. That's how we are going to get out. And like I said, for covered calls, when you sell options, you want the value of the option to be less when you do so, right? When you sell a covered call, essentially you want this to go all the way down to 0 at expiration. When we sell an option, we want the premium value to increase over time so that we could sell it back at a higher price than we bought it. Let's talk about spreads real quick. Now, guys, there's many different types of spreads: vertical spreads, diagonal spreads, horizontal spreads, that really calendar spreads. So what we're doing with this spread, right, is we are spreading out a buy option and a sell option. And depending on the premium, you will either receive a credit for a credit spread or a debit for a debit spread. Now, there's sometimes we combine them together, like the iron condor is pretty much 2 spreads, but closing them is fundamentally the same exact as before. But there is a little bit of a caveat with spreads. Let's take a look at what a spread might look like. I might buy a call and I might pay a premium of $20. So this is going to be a debit when we buy. Now, maybe I want to sell a covered call against that. And what happened here was I received $35 in premium, right? So this is going to be a credit spread. This is going to be plus $15 worth of profit. That is the value of this spread. Well, maybe sometimes later, now the value of that spread has gone down to $10. So now the value of this option is worth $10, and now you can close this spread and keep the difference of $5. How do we do that? We have to close them with a -1 and a +1 at the exact same expiration date. Now here's the warning, guys. You cannot close these one at a time with most brokerages if you do not have extreme margin, because that's called being naked. The reason that we do spreads is because it lowers our collateral. It lowers the amount of buying power we need as collateral, or the shares that we need as collateral. So you're going to have to close these at both times. So we have to think about liquidity. Spreads are great for getting into if you have small portfolios, but they are very, very tough to get out of sometimes depending on liquidity. And how are you going to kind of mitigate against this? You're going to look at the bid-ask spread, which I think I need to do a video on coming forward. If you want me to do a bid-ask spread video, just let me know in the comments below, because I think that one needs to come. If there's a really, really wide bid-ask spread, that means liquidity is low, and it's going to be hard to fill this, because like I said, you say, hey, I got this spread, I'm selling it, somebody has to buy it back from you, and vice versa. You can't just create it, it's not automatically going to get fulfilled. So sometimes we have to vary that bid-ask price, that bid-ask spread price, and we're going to lose money by giving up some money or taking some money. Like, there's always going to be give and take with that bid-ask. So with spreads, super easy to get into. They're great because they have low collateral, they have low buying power, like things like that. But if you get yourself into trouble, they are very, very hard to close because of liquidity. If there's a big bid-ask spread on them, be very, very careful and make sure your spread is in a position where you're almost positive it's going to work out. And if it doesn't, your collateral is low enough where you don't lose the whole house. And this would become even more difficult with an iron condor, which was 4 legs. If you don't know what that is, I did a video, I'll post it. But let's say you have a +1 and a -1 spread here. This is going to be above the share price, right? So this is the share price. And then we have a -1 and a +1 down here below the share price. To close this, we need to do the opposite, +1, -1, and up here, -1, +1. Same expiration, same strike prices. Now, I said with liquidity, it's hard to close 2 legs at a time. Guys, closing 4 legs at a time is even more difficult. And these are scenarios that you need to understand. All right, I'm making this iron condor. Liquidity is pretty low. It might be pretty tough to get out of. Let's make sure I make my short positions really, really wide so I don't have to worry about getting out of them if I really need to. Things like that. And I get asked, can I close 1 spread at a time? Yes, depending on your brokerage, it really matters on who you're working with. Like, say you wanted to take this spread and you wanted to move it further as the share price started to drop. Yes, but you can't close 1 of these at a time because, like I said, then you'll be naked. That's not going to be a good thing. Let's jump into Robinhood and look at these guys. But before I do, if this video is giving you some value, YouTube doesn't really push out options videos, so please give it a thumbs up. Just leave me a comment or something. Let YouTube know that you're getting some value from this. I'd really, really appreciate that so that more people learn how to exit these strategies. Right now, this is my options portfolio pretty much right now inside Robinhood. I have a bunch. What I'm going to do is I'm going to look at one of my Dropbox calls. So I bought Dropbox. So here's that +1 that we were talking about. I have a +1 contract. Here is the cost that I paid, $790. Or $7.90 in premium. The current value, so this chart that's going up and down over time, the current value of this chart is at $980. Over here on February 8th, that value of $12, that means nothing right now. All that matters right now is this. So we don't have to worry about what this graph is doing throughout the timeline. But what does it tell me? Well, it tells me right now its current value is $980. I paid $790. So I could sell this right now for the current market value of $980. What that would do is right now, that would give me a return of $190. So let's look at this chain. Right now I have an expiration of 1/20/2023 at a $17 strike. So I go to my expiration all the way down to 2023. I see the $17 strike of a +1. If I wanted to close this option, all I would have to do is I would go to the opposite, sell. I would click this button, 1 option order. That would close it. I would receive a credit because I sold for $980. If that got fulfilled, bingo, bango, that would be the end of the day. But I really, really wanted to drive home this value does not matter until you are going to use it at that particular point. Let's look at a covered call. So right now, this Avi is showing me $39 loss, right? And I see people and they're like, oh man, I thought my max loss was I'm going to get my shares covered away. Where am I going to come up with this $39? My portfolio is screwed. I'm going to lose all my buying power. That's not the case. Let's go and look at Avi and why it says that I am minus $39. Because I got credited $44. I sold this option for $44. Now, what the value chart is telling me is that I screwed up. Should have waited a little bit. Should have tried to time the market, because if I would have done so right now, I could sell that option for 83, right? I could get a credit of $83 right now. So what it's doing, it's showing my total return as a loss, but I didn't lose anything. I lost what I potentially could have got if I waited. Now, what does this mean to me? Well, what it means is I am not going to buy to close this option, because if I were to buy to close, I got to pay $82 in premium, but I only got 44. That's not a good deal for me. So that's why it's showing me at a loss. So I have a couple options. Keep waiting till the value goes down and theta eats it away, or just let it keep going. Hopefully it gets expiration. Right now it's at a share price of 108. I have a call at 111. So right now this is worthless. I'm still at max gain right now of $44, even though the value is telling me I'm at a loss of minus $38. Let's look at a call right now that's currently profitable for me. So when I look at this Dropbox covered call, -1, I sold this option. I got a credit of $19. Sweet action. But right now, its current market value is $15. So right now I could buy this option back for $15, netting me $4, a 21% gain. Like I said, if I was happy getting 21% on this option, maybe I did this today. I probably wouldn't do it because you'll use a day trade. Maybe tomorrow, if it's 20%, I'm like, wow, I just made 20% of my money in one day. Boom, I'm going to buy to close. I'm going to get back $15, and that's going to be it. And you can see during the day, it got back up to $24. So that was not good for me. All right. So these are the things. Don't worry so much about this. Worry about what the value of the option is and what you either paid for it or what you didn't. I'll show you a call option that's at a loss right now. Let's take a look at this Apple buy that's just getting crushed right now. So I bought this for $2,170. All right, it's going to expire in September, so I have plenty of time. But the value, all right, what's going on with tech right now is it's plummeting. So the current value of this option is $1,343. That is right now, the value of that option has lost 38%. I've not lost 38%. The value of the option has. I still have plenty of time to expiration for this to rebound. But if, say, news came out of Apple and I was like, oh man, Apple's going to go bankrupt tomorrow, or the share price is going to keep diving and diving, meaning the value of this option is going to be diving. I might say to myself, I'm going to sell to close this option. I'm going to get $13.43 back. I know I paid $21.70 for it. I'm going to lose $827 in this trade, but I'm going to mitigate that loss because if it stays below the share price and expires worthless, I'm going to lose $2,100. So I might, in this case, sell to mitigate loss. Now, I'm not going to do that because I think that Apple's just having a bad week. And I think before September, they'll do the things that I want them to do. But this would be a situation where you would sell to close to mitigate some loss. I really do hope this video helped, guys. If you know somebody that's in hot water and they need to get out, please, I beg you, share this video with people. I'll keep making educational videos like this. YouTube hates them, but I know they're really valuable for you. So please share, give the video a thumbs up. And until I see you guys in the next one, stay positive, work really, really hard. Always, please, be kind to other people. Hope you have yourself an amazing day and an even better tomorrow.